Whether you make a transition to a day trader or remain a swing trader, you should always keep your eye on outstanding shares and float, as well as market cap. The main difference between the OS, which is the outstanding shares, the main difference between the OS and the float is the inclusion of restricted shares. So outstanding shares are all the stock held by the public, including the restricted shares that are held by the company's insiders. So this means that the float is calculated by taking the outstanding shares and subtracting the restricted shares. So in that bullet point under float, you can see if a company has 20 million outstanding shares but only has 17 million float, then the restricted shares makes up the difference of 3 million. So when you're trading a stock that has a small float, most likely it will be very volatile with a higher beta. So let's go ahead and take a look at a few examples. And you should also check the outstanding shares in the float as well as the market cap for those stocks that you picked from Dow Jones a while back. Okay, now let's look at a couple of companies for their outstanding shares and float. One company I want to look at is DGLY. Now this stock and Taser skyrocketed after the unrest in St. Louis due to the shooting of Michael Brown. Both Digital Ally and Taser, another one of my favorites, they both saw a spike in their equipment orders from law enforcement. Digital Ally makes video cameras, and Taser needs no explanation. So let's go ahead and on the left side again, let's click on key statistics, and we're going to take a look at the shares outstanding, which is 3.01 million, and then the float is 2.62 million, and the difference is the restricted shares held by the officers. And it's also interesting, look at the beta. See, the beta is 4.36, and if you recall again, 4.36 of beta means it is 336% more volatile than the S&P 500, which has a beta of 1. And also let's look at the market cap. It has a $44 million market cap. And remember guys, market cap is going to change on daily basis because of the stock price. Outstanding shares will be the same, but the stock price always changes, so the market cap will always change as well. And then let's look at another company, Berkshire Hathaway, the most expensive stock, Warren Buffett's company. So this company, let's go to key statistics. Look how small the outstanding shares is on this one. See, shares outstanding 1.6 million shares versus a float of 1.26 million. Market cap of 357 billion, and the volume is very low. 373 shares. Only 373 shares trade in one day. That's that's crazy. I wonder who actually trades these stocks. I will never touch this stock ever. There's also Berkshire Hathaway Type B for people who cannot afford Type A. So if you want to trade Berkshire Hathaway, then $148 a share is a little bit more sane. All right, let's go back to the course. So when you're trading a stock that has a small float, most likely it will be very volatile and it will have a higher beta. Market cap, we already talked about that several times. This figure is used to determine a company's size in comparison to other companies, but a better representation of a company's book value relies in enterprise value, which we'll discuss more in part 2. So enterprise value will actually account the debt of a company, and it will also subtract the cash and cash equivalents, and it is kind of like a theoretical value of a takeover value. So if let's say a company wanted to take over another company, how much would it pay for that company? Enterprise value would be a better gauge than a market cap that always changes every day and just looks at equity, and that's it. Let's go ahead and take a look at let's say Facebook's market cap and contrast that to its enterprise value. So you go to Facebook. Let's say Facebook has a market cap of 212 billion, but if you go to key statistics and look at the enterprise value, see the EV is much lower. So technically Facebook is 198 billion, not 212 billion, what market cap states. And don't go and look at this and state that, okay, just because enterprise value says 198 billion and the market cap says 212 billion, that doesn't mean that Facebook is overvalued, and we'll talk about that more in part 2. But there's many traders that investors, I should say, that actually look at this and think, oh, okay, that enterprise value is lower than market cap. That means that I should sell the stock because it is overvalued. That's not the case. So it is intuitive that companies with smaller floats tend to be more volatile than companies with larger floats. And in the case of DJLY and Taser, I was fairly successful on those few trades when St. Louis unrest was going on in the news. What happened was the daily volume was skyrocketing, and there's a lot of money that was changing hands, and companies with small floats such as Taser and DJLY tend to give you very, very substantial gains. So imagine if there are a lot of buyers of a particular stock but not too many shares available to purchase. The result will be a surge upwards in explosive dollar gains, but the opposite will also hold true if investors sell in panic. Therefore, a small float is a double-edged sword, and that's exactly what happened. You would make 5 to 10%, but then the stock could pull back 3, 4, 5% just as well, and the investors or traders that would come to the table a little bit later would get their asses handed to them pretty much. You would be amazed how many times I hear people say something that costs $1,100 a share is more expensive than a stock that costs $15 a share. I had this one neighbor, after trying to explain it to him mathematically that it's pretty much the same thing, because you buy more shares of one stock and then you buy less shares of another, but you still make the same percentage point. He still didn't get it, and I just gave up on trying to explain it to him. This is one of the reasons why I don't want to teach on a class setting, because I don't think I can handle all the questions. I don't think I can handle explaining it to people who just don't get it, and when their mathematics is not their strong suit. So some of this stuff is just common sense, but let's just go ahead and get it out of the way. So over and over I advise people to buy Priceline, but all I hear is, oh no, $1,100 for one share is too expensive. I'd rather buy 100 shares of Ford at $15 a share, as if this will make a difference. Remember, it is the percentage gain or loss that counts with the amount invested, not the dollar gains. So let's say if AutoZone is trading currently at $346 a share and Bank of America is trading nearly at $12 a share. Yeah, the former is more expensive than the latter in terms of dollars per share, but new investors forget to look at the fundamentals before making that judgment called whether a stock is pricey. What constitutes whether a stock is cheap or expensive has several valuation components, but the ones that create the most impact are the financial health of a company and future expectations of the investors. Okay, there's a lot of components that go into whether a stock is cheap or expensive. It's kind of like the eye of the beholder. If a company like Tesla has major future expectations, then yeah, it might be considered cheap. If a company like Boeing is buried in debt, but they have orders of new airplanes for the next 40, 50 years, then of course it's going to be considered cheap in some level. Even though they're buried in debt, some analysts will say, hey, they have job security. They pretty much have orders lined up. So they have this constant cash flow that's going to come in each year. And that means stability for a lot of analysts. And they might look at that as a company that's regarded as cheap when it falls below a certain threshold. So fundamental analysis day 2 will focus on valuation of stocks and assessing, quote unquote, the intrinsic value of a company, the true value of a company, a stock share, which will give you an idea whether a stock is considered cheap. Now I'd like to pick your brain a little bit, as I have very weird ways of explaining my logic through different examples. And one example I came up with is called the pecan pie example, because I love pecan pies. So, let's say we got 2 stocks, okay? But in this example, we're going to have 2 different pies. So, one pie A, is split into 5 large parts in reference to it being the AutoZone with a smaller float. So, stock has smaller float. It means it has less shares available, which means it has more of a value if you think about it, right? It has more value since there's less shares. So pie A is split into 5 parts, okay? We sliced it into 5 parts. And then we got pie B is split into 42 tiny parts. And we're going to refer to pie B as it being Bank of America, that has a very large float. I forgot how many billion it is, but it's in the billions, versus AutoZone is in the millions. So what do you think? Which pie's slices would have more value, A or B? Now you think about that for a second while I drink my tea. Wow, this microphone picks up everything, huh? Okay, so the bigger the pie size, the higher its value. Granted, if the large pie slice equates to a financially strong company like Apple, let's say. Now, if instead of pie A, you told me that you may think pie B has more value, because despite it being butchered into little pieces, it is made out of the finest ingredients, whereas pie A is made out of expired flour that might make consumers get sick, then you have a point. See, that's the different way of thinking about it. So those ingredients that can make a difference whether why one stock can be considered more expensive than another lies within many financial components of a company. Its debt levels, competition, product lifespan, cash flow, etc. So even though Bank of America is currently plagued with mortgage lawsuits and uncertain economic conditions that can affect its earnings in subsequent quarters, it can still be valued more than AutoZone, in my personal opinion, regardless of its market cap or its float. Now whether a stock is considered cheap or expensive versus its current stock price is a whole different topic, which will encompass a new term called intrinsic value, which we'll discuss that in part 2, which is going to be a very grueling process. Now we're gonna get to a new section called corporate actions, and we're gonna see different ways that corporations change the financial structure of their companies. So the most famous action that everybody knows is stock splits. So a traditional stock split occurs when a company increases the number of shares outstanding. The actual value of the company doesn't change, but the number of shares will increase based on the parameters of the split. So if Walmart is trading $60 and a holder has 100 shares, the day after the 2-for-1 split, a holder of the stock will now own 200 shares of Walmart, trading at 30. And splits can be as much as 10-to-1 even. And in Apple's case, it was 7-to-1. Now let's go ahead and take a look at Apple real quick on Google's finance. So with Apple currently being 107.75, if you want to know the old price of Apple before it had a split, all you got to do is multiply this by 7 and you will get what, 700 and some dollars. So if you look at Apple 1 year chart, you will see there's a little green S, stands for split 7-to-1 on June 9th 2014, and I forgot how much it was trading at that time. It was probably like 600 or so, probably less. So yeah, so that's the traditional split. And then we have reverse splits. Reverse stock splits is the same thing but the opposite, but it is a cause for concern, because when a company does a reverse stock split, it's usually a red flag, because the company is trying to prop up their stock price to maybe attract hedge funds or investors who want to shy away from companies, let's say, that trade, I don't know, less than $10 a share, for example. So a reverse stock split occurs when a company decreases the number of shares outstanding. Again, the actual value of the company doesn't change, there's just a change in the number of shares outstanding. So if Walmart is trading at $40 and a holder has 200 shares, the day after a 1-for-2 reverse split, the holder would own 100 shares trading at $80. And then there's also spin-offs and tender offers. In a spin-off, a corporation will divest itself of a business division and create a new public company. So holders of the shares of the divesting company will receive shares in the new entity. This happened to me when I was heavily invested in Potash, P-O-T. And Potash did a spin-off and separated their phosphate business into Intrepid Potash. Their potash business into a separate company called Intrepid Potash, trading under IPI. And there's different reasons why companies decide to do this. Sometimes maybe that separate spin-off might be doing much better than its other segments, and it might be hurting company's other side of business and overall company. Basically, it's like if you put a rotten apple into a bunch of nice apples, it's gonna rot away the other apples, right? So sometimes it's good to separate that good apple. And that's sometimes what the case is with companies too. Or the opposite could also be true. If a certain segment doesn't perform as well, they might want to go ahead and separate that rotten apple by itself and keep all the good apples intact so that their investors will not leave because of that one rotten apple. And there's, let's say, tender offers. Tender offers are the result of an attempted takeover of a company. So the potential acquirer will offer to purchase all shares of the company at a specific price. If stockholders are willing sellers of their shares, they will tender their shares for sale at a specific price. Most of the time, guys, not all the time, but most of the time, if you're in a company that gets acquired, your stock will surge higher. So why does a stock rise or fall? I mean, we all understand the supply and demand aspect of it, but a lot of it has to do with intrinsic value, and we've thrown this term around loosely, but let's try to define it first. The intrinsic value is the actual value of a company based on an underlying perception of its true value, including all aspects of the business, in terms of both tangible and intangible factors. This value may or may not be the same as the current market value. So, again, intrinsic value is the true value that everyone is trying to pinpoint. But does it even exist? Because the stock price is always changing, right? So the stock price is always changing, and you have millions of people who have different opinions. Some think it's undervalued, some think it's overvalued, but at the end, the invisible hand of Adam Smith is actually what dictates the actual stock price, as the buyers and sellers come to a conclusion of a common price to sell and buy their shares. So what is the question? Is it overvalued or undervalued? So value investors, they use a variety of analytical techniques in order to estimate the intrinsic value of securities in hopes of finding investments where the true value of the investment exceeds its current market value. And again, we're gonna do discount cash flow analysis. I'm gonna do Gordon growth models, and not day 2, but the part 2 of the course. So value investors that follow fundamental analysis look at both qualitative, which is the business model, governance, target market factors, etc., and quantitative aspects, which is the ratios, financial statements, etc., to see if the business is currently out of favor with the market and whether it's really worth much more than its current valuation. Now, there is such a thing called efficient market hypothesis. I'm not sure if you've heard of that theory, but it basically states that it is impossible to beat the market because the stock market efficiency causes existing share prices to always incorporate and reflect all relevant information. So according to the EMH, stocks always trade at their fair value on stock exchanges, making it impossible for investors to either purchase undervalued stocks or sell stocks for inflated prices. As such, it should be impossible to outperform the overall market through expert stock selection or market timing. Now, when the EMH was, efficient market hypothesis was coined, it was a very long time ago. But now with the technological advancement and the day traders and scalpers that came forward, this theory proves to be wrong more and more. So the EMH is highly controversial and often disputed, especially now. So for example, investors such as Warren Buffett have consistently beaten the market over long periods of time, which by definition is impossible according to the EMH. The detractors of EMH also point to events such as the '87 stock market crash, when the Dow Jones fell by over 20% in a single day, as evidence that stock prices can seriously deviate from their fair values. And I agree, not only the '87 crash, but we had the 9/11 catastrophe happen, which tumbled Dow for 6.8% or so. So, we have Carl Icahn, which made his money from finding little mispriced opportunities and trading options and derivatives. So that's how we make our money. We pretty much constantly look for opportunities where the stock price actually deviates from its true intrinsic value. And the more you do it, the better you get as time goes on. I'm going to lightly touch on the EPS and PE ratio subject in the next couple of slides, and we will delve deeper into it in part 2 of the course. As you already know, everything boils down to earnings per share, right? Before the earnings results are released, financial analysts will try to forecast the earnings of a company. So you will often hear these quote unquote whispered numbers on TV, and the ultimate question is whether the company will be profitable enough to meet those analysts' consensus expectations. So if it does, then most likely the stock will rise on that day. And if it doesn't meet the forecasted EPS, then the stock most likely will fall. However, let me state that there are other reasons a stock may fall at earnings release, such as lower margins or a weaker forward year guidance, etc. So EPS is generally considered to be the most single important variable in determining a share's price, and is also a major component used to calculate the PE ratio, which we're going to look at on the next slide. And lastly, let me just say that don't confuse EPS with dividends. Okay, the company can plow back its earnings back into its balance sheet and don't pay a single dime in dividends to shareholders. And those are the companies that are considered growth stocks. They hoard all the cash. They don't, all the earnings per share that they make, they keep it to themselves so they can grow faster. One way you can find out how much dividend versus its EPS a company is paying is by looking at its payout ratio. So let's go ahead and take a look at Apple real quick and see how much Apple is paying out to its shareholders. Go to Yahoo Finance again and click on Key Statistics. On the right hand side, you will see payout ratio 28%. So this 28% means that Apple's dividends make up 28% of their EPS, earnings per share. Okay, PE ratios, otherwise known as the multiple. I know Jim Cramer loves to use the word multiple, but when you hear that, that's what they're talking about. So price to earnings ratio is a valuation ratio of a company's current stock price compared to its EPS. Okay, so the formula is PE equals current stock price divided by the EPS. In other words, basically all PE is how much money are investors willing to pay per dollar of earnings. Sometimes the PE is high. I've seen PEs go up to 100, 150 especially during the tech bubble, and even recently with the Rackspace. That's one of the recent companies based out of San Antonio. The PE ratio went up to like 50, 60, and it was just way too high. So there's an example. If a company is currently trading at $43 a share and earnings over the last 12 months were $1.95 per share, the PE ratio for the stock would be 22.05, which is 43 divided by $1.95. So EPS is usually from the last 4 quarters. Okay, that's the trailing PE. But sometimes it can be taken from the estimates of earnings expected in the next 4 quarters, which is called the projected or forward PE. So just make sure that you base a lot of your decisions on trailing PE, because the forward PE is not always accurate. So let me just talk about why PE ratios alone do not tell the entire story. In general, a high PE suggests that investors are expecting higher earnings growth in the future compared to companies with a lower PE, right? However, the PE ratio doesn't tell us the whole story by itself. Okay, it's usually more useful to compare the PE ratios of one company to other companies in the same industry, or to the market, or against the company's own historical PE. So it would not be useful for investors using the PE ratio as a basis for their investment to compare the PE of, let's say, a technology company, which is a high PE, to a utility company, which is normally a low PE, as each industry has much different growth prospects. As I said before, utility companies have caps on how much profit they can make. So investors are not willing to pay high prices for their earnings because they know this. Utility companies pay good dividends just to keep investors intact. But as far as growth is concerned, technology is the space to be. The PE is sometimes referred to as the multiple because it shows how much investors are willing to pay per dollar of earnings. If a company were currently trading at a multiple PE of 20, the interpretation is that an investor is willing to pay $20 for $1 of current earnings. Also, it is important that investors note an important problem that arises with the PE measure, and to avoid basing a decision on this measure alone. So the denominator, the earnings part, right, is based on an accounting measure of earnings, and that is sometimes susceptible to forms of manipulation, making the quality of the PE only as good as the quality of the underlying earnings number. So just beware of that. There's a lot of accounting scandals and with Enron and other companies. So PE alone do not tell the entire story. In part 2, we will take a look at PEG ratios and other evaluation methods that is way more accurate than PEs alone. So as an assignment, I'd like you guys to start comparing PE ratios of companies that are in the similar industry. So for starters, go ahead and compare, let's say, Verizon to AT&T. So compare VZ to T. Even though AT&T has many more business segments than Verizon, but I think it is still fairly a good comparison. Okay, guys, clear your desks, please. And it's time to take test number 1. I'm sure you're going to definitely enjoy this test because it is going to be the easiest test that you will take out of all the 4 parts. So enjoy it. Please don't Google for the answers. I'm sure you're not going to. And there's a couple of bonus questions at the bottom as well. So I think you'll have fun with this. It's a very all of the answers should come from all the slides that you just reviewed, and hopefully you didn't fall asleep. And anyway, after this slide, I'm going to show a model portfolio, as I promised, how a typical hedge fund would actually allocate $1 million portfolio, let's say. And also, we're also going to look into different types of discount brokers, and we'll talk a little bit which one offers a better commission versus a better platform and so forth. All right, so go ahead and take your tests. Some of you might decide to stay as an investor and not day trade after taking this course, and that's fine, but I wanted to show you well, first let me tell you how saddened I will be if that does become you, because in my opinion, I have a higher probability of guessing what's going to happen to a stock a couple of hours from now rather than a year from now. So with that logic, to me it makes sense to trade short term. And just like I showed the chart at the beginning of this course, when you can actively day trade and take short and long positions rather than traditionally long, then I think you have a higher chance of success, in my opinion. Unless you have so much money that you don't mind. Let's say you have, I don't know, couple of $1 million, you want to throw it in treasury bills and mutual funds and just live off the interest very frugally, then that's a different scenario. But I'm assuming most of you that are watching this video want to get to that level. So if you're not there yet, it's you have no choice but to take more risk at the beginning to build your wealth, and as you become richer, you will take less and less risk. And hopefully one day you'll become like Warren Buffett, where you can just buy a large company and sit back for 10 years and not care about the recession. All right, so I developed this $1 million portfolio example. So if there's a wealth management company or a hedge fund, probably mimics the way I have here, or very close, as far as diversification is concerned and the fund allocation. So let's go ahead and take a look at this. We split it into 4 parts, and let's say $400,000 out of the $1 million would be used in dividend stocks to capture those dividend yields on an annual basis. Also, it all depends, if this hedge fund has aggressive clients or they're more conservative, but this is kind of like in between, basically medium risk level. So yeah, you would have $1 million divided into 4 parts, and let's say we'll put $250,000 in technology, energy, and retail, and another $250,000 in healthcare, construction, auto, defense, and another $250,000 in commodities such as gold, real estate, dollar, coffee, orange juice, and another $250,000 in financials, consumer goods, and discretionary. The reason I set the dollar in the commodities section, I put it in there because often US dollar is hedged with, if a fund is holding a lot of multinationals that receive their revenue abroad, it is always a good idea to hedge with the US dollar. Companies like Procter & Gamble, even McDonald's, happen to be very good hedges against the dollar. And then let's say we take that one piece of the pie and then break it down even further. So $250,000 in technology, retail, and energy would break down to, let's say, $100,000 in technology, but within that $100,000 you would have a long and a short position. So you would have, let's say, 50,000 in Apple, 40,000 in Google, and you will have a tiny position of 10,000 into BlackBerry, a company that is not financially stable. At one point, they were going to headed towards a bankruptcy if their Z10 Hail Mary didn't come through, but they're still surviving. But you always have these really crappy companies that a wealth management company a hedge fund company might decide to short. So same thing, let's say on the retail segment, you'll have 50,000 in retail, you'll have 30,000 in Walmart, 15,000 in Costco, but you'll have a small short position in JCPenney. And it's funny that I've wrote this a while back. I've wrote this probably like 4 months ago, this slide, and right now a news article came that JCPenney is closing down another 40 stores, and they're in a very horrible position now. They're just trying to downsize and restructure. And then the last one, 100,000 in energy, you'll have again 40,000, let's say, in Chevron, 40,000 in Shell, and then you'll have 20,000 in Walter Energy, short position. Walter Energy makes metallurgical coal, and they got hammered because of the lower coal prices, as well as the regulations lately, EPA regulations that hit the coal industry very hard. But Walter Energy used to be a $100 company, and it was sad to see it in single digits. Anyway, so let's say you'll have 70% of the portfolio would be used in mega cap stocks, right? You would have 100 plus billion market cap companies. So if a company is fairly large, more than 100 billion market cap, you would have a lower beta. And as you recall, beta is a measure of risk. So you would have a lower risk, lower volatile company such as Apple, Amazon, Berkshire, Budweiser, Pfizer, Novartis, Coca-Cola, and so forth. Majority of these guys are in the Dow Jones, and you're already familiar. So 70% of the portfolio would be allocated and be in this arena of the mega caps, right? And then you would have 20% of the portfolio, you would range a market cap of, let's say, 25 to 99 billion with moderate beta. Moderate beta risk would achieve moderate yields. So, they want to go a little bit more aggressive, so they would push the beta even higher and stick to a smaller cap companies. Not small caps, but smaller than, let's say, 100 billion threshold market cap. So, companies like American Express, CVS, Facebook, Ford, US Bancorp, Visa, still solid companies, but they're fairly smaller in size. And then you will have, let's say, 10% in more riskier companies. Even though when I say riskier, I'm still talking about at least $1 billion in market cap, from billion to 25 billion, and they would have a higher beta. So higher beta would actually yield higher profit. So smaller percentage of that portfolio would go to these riskier companies. You got names like First Solar, D.R. Horton. These are very volatile companies. Netflix, high risk momentum companies. Tesla, Under Armour, Michael Kors, Whole Foods. At one point, Whole Foods was not doing too good, especially when Walmart is starting to come into the organic business. Even though you cannot compare the two, but Whole Foods saw a temporary decline. I think they're doing better now. And trading, it's like making more than 1,000 mistakes. After every mistake, you will improve. Unless you're just plain stupid, then yeah, you're not. But if you're a logical person, you have common sense, after every mistake you make, you back test and you go back and see what you did wrong, and hopefully you won't make the same mistake again. There's a lot of people, I'm sure, that make the same mistake over and over and over. And, I just hope you're not one of those people. So each mistake will cost you money. Okay, large mistakes might cost you $200 to $1,000, even more. Happened to me. I've lost more than $1,000, way more. And small mistakes will cost, let's say, $10 to $200 of unrealized losses. So the question is, how much can you withstand? You know what I mean? How much money are you playing with? How much can you afford to lose without just quitting completely? And I don't want you. I want you to stay in the game. I want you to learn the whole thing through. So in order for you to stay in the game, don't worry about making a lot of profit at the beginning. Just make sure that you do make profit. Even if it's a small profit, it's still a profit. I'd rather have you make less profit and trade more rather than have a couple of home runs and you think you're invincible. That's exactly not what I want. And honestly, that's exactly what might happen. You will hit a couple of home runs and you will think you're invincible, and that's your next mistake will be the learning curve. And most people, that's what happens. So, but each person will have their own trading path, will have their own destiny. So, and they'll have their own what's the word? Learning curve. The aha moment. So the aha moment will come. It's just gonna take months and months, maybe even years. I'm not gonna lie to you. So eventually you're gonna look at your tax returns and realize that now you'll be paying a 25 to 35% capital gains tax instead of writing off a loss. I just realized that at the beginning of this course, I put, I think, 10 to 35% capital gains tax. I should have put effective tax rate. That's what I meant. Of course, the capital gains tax is about 35%, but with a good CPA and you understand how to write down your cost, I mean your expenses as a day trader, your office, your printing supplies, and everything that you can deduct, you can bring down your effective tax rate to more reasonable levels. So as your level of experience increases, you will allow yourself to take more risk, which will consequently yield more profits. However, if you take more risk than you can handle too soon, you might find yourself going back to the 9 to 5. So I don't want that to happen to you. Once you become a full-on day trader and you start living off of it, the worst thing that can happen is just go back to the 9 to 5, because it is a feeling of failure, feeling of self-doubt, and it's a really horrible feeling, and I don't want that to happen to you, because I've been there several times. Okay, let's move on. I want to tell you a little bit about my weaknesses that I had. When I was starting out, I loved to buy everything. That was my main problem. I would buy everything until I had no money left. So I would buy everything, and then I had no cash on the sidelines. And then when, let's say, a stock would fall terribly, and I was like, okay, man, I wish I had more money, and I wish I had more in my margin account so I can buy more, and I didn't have any more. And because I bought everything too soon, and that's just not what you want to do. Another thing is I sold too early. I'm always like, okay, let me take profits as soon as I can. That's one of my weaknesses. I don't let the trend finish. As soon as I have like $100 in profits, I cash out. But if I could only wait another couple of minutes or an hour, I would probably make another $200-300. So that was my problem. I would sell too early because I would rather have smaller profit, but at least have the feeling that, okay, I actually made money. Not I succeeded, I didn't fail. Which I guess is a good thing, but as you gain more experience, you should also learn how to sell at the right time, or sell efficiently and optimally. Another one of my weaknesses was I was impatient. I was impatient and I would buy in too quick. So being impatient is not a good thing at all. Sometimes it's a good thing when you get lucky, but most of the time, patience pays off. And also, I was a terrible short seller, and I still am. Honestly, I rather be on the long side. I feel more comfortable on the long side, but I do short sell and I do hedge. And the reason I was a terrible short seller is because short selling has to do a lot with timing. Timing at the right moment. You blink your eye, and it's just like, okay, now you have to cover your short sales. So if you don't time it right, now you have to wait for the next setup. So I didn't like that part of it. I like to get into a nice position set up on the long side and watch it incrementally go higher. I looked at short selling as playing video games. You just kind of have to time it, at the right second. So, and it happens so quick, because fear sets in faster than greed. So when there's fear, people panic. You have to be there, glued to your computer. You have to be there, take advantage of that short setup and cover and move on. And I'm still trying to work on that, my shorting skill, and it's always a never-ending improving process. So after 3 to 6 months of consistent trading, you will probably understand your weaknesses, and then after 6 to 9 months, you will accept them, because you're going to go through this phase of being in denial that no, what you're doing is right, and you might even start switching your strategies or the way you do things, um, and you would switch it at a time where the entire market sentiment might change, meaning the entire cycle of the market might change, and you might be in a different month where, let's say, all the major funds are closing their books, or right before the year ends, you change your strategy at a time where stocks are acting irrational and there's a lot of losses, companies taking a lot of losses to close their books or what have you. So stocks are acting irrational and you're changing your strategy exactly at this moment. But if you didn't change your strategy, maybe your strategy would work on this month, but on the next month it might not work, and then on the month after that might start working again. So you might fall into these scenarios where maybe you shouldn't change your strategies and try that for at least 3 to 5 months before starting to tweak them, so then after 9 to 12 months, hopefully you will begin to improve on them. You will start to understand what you're doing wrong. You will go back and look at your financial statements and see, okay, where did I go wrong? When I entered this position, why did I do this? And start questioning every one of your trades. And preferably you should do this when it happens recently. So, every week, just look at your week of trading and try to analyze it. Try to discuss to yourself as to why you did what you did, and was it warranted? And sometimes it was warranted. You did the right thing, but you still lost money. So if that situation happens again, are you going to do the same thing again? Sometimes you might have to, so you will come across those scenarios as well. Lastly, I want to share a book that actually got me into trading, which was Alexander Elder's Trading for a Living. That was the book that opened my eyes to the wonderful world of trading, and talks a lot about the psychology of trading, which is pretty interesting. So lastly, I want to tell you that the rich can afford to take less risk. The poor can't. I'm sure you already know that. So the richer you get, the less risk you can take. Think about a trust fund baby living off of 2.6 million in T-bills, which is risk-free treasuries. He doesn't need to take a lot of risk. He doesn't need to trade options. He doesn't need to trade small cap stocks. He made it. That's it. As long as that person keeps his expenses low, his treasuries will pay interest risk-free, meaning the government is not going to default on that debt. But when you trade equities, you always have that risk of a company going bankrupt. Alright, so as novice traders, you will be tempted to take a lot of risk to play catch-up, but in actuality, one must take as less risk as possible in order not to jeopardize life savings and get to your goals safely. And this is a mistake that almost everybody does when they start trading. They take a lot of risk. They take a lot of risk because they want to make a lot of money in the stock market. But that's not how it works. You take low risk first. You take less risk. As you gain more knowledge, you slowly increase your risk. So a fine balance between risk and safety is the key. And the solution to that is avoid options and stick to companies with more than $50 billion in market cap, as I stated before, until you gain more experience. Now let me give you a couple of more tips before we go into the discount brokerage assessment. One risk that beta or any other type of risk calculation doesn't take into account is the bankruptcy risk, or I call it the unnecessary risk. As a novice trader, your ultimate goal is to eliminate unnecessary risk. Now let me tell you what I mean by that. This means that you need reassurance that your stock will reverse its course after a major fall and won't head towards bankruptcy in case recession hits. Meaning, if something goes wrong, you have the option to wait it out until it comes back to the point, or at least close to the point where it fell from. Because of this, you will need to select companies above $50 billion in market cap to be safe until you master trading, and then you can get into the more riskier companies. But that's not what beginners do. What beginners do is they come in, and the first thing they do is they jump on these small cap, micro cap companies that go up 40-50%. They make a couple of good trades, they become ecstatic, and then they lose their shirt and they don't touch the market ever again. I don't want this to happen to you. I want you to incrementally increase risk as you gain more and more knowledge. And at the bottom I put exceptions: Enron, Tyco, Blockbuster, because these were major companies. These are large market cap companies, but even they went to bankruptcy because of fraud, and then because of pure stupidity on the Blockbuster's case. And I say stupidity is because those old what do you call them? I forgot my train of thought. Those board members that didn't look at Netflix as a potential threat. Netflix CEO pretty much went to them and said, hey, more and more people are starting to watch stream TV on their laptops, and they just laughed at their face. Netflix wanted to do a partnership type deal with Blockbuster, and Blockbuster pretty much told them to get the hell out. And I love exactly what happened. It's a dog-eat-dog world, and Blockbuster evaporated within a couple of years. I loved it. Another thing is position size is of utmost importance. Okay, position size is everything. Every single time you buy a stock, you must know the financial health of the company, which should allow you to decide on your position size. And you will not understand how to evaluate financial health of a company until you watch part 2 of this seminar. Your position size should also dictate whether you expect the stock to fall further or it will gap up and not pull back. Crappy companies equals smaller position size. That's it. That's bottom line. Don't ever violate that rule. Crappy companies equals smaller position size. Or if you're going to short sell them, that's a whole different issue. But if you're going long on a company that's not financially stable, they're heavily indebted, or their income statement is full of losses, then beware of what you're investing in or trading. And always analyze a couple of steps further. If this happens, what am I going to do at this point? And if it runs higher, how much am I going to sell? Always pre-plan all of your trades. And I put list of crappy companies like Jamba Juice, BlackBerry, Candy, Vivas, and you'll have your own list, I'm sure. There's a lot of momentum crappy companies, but just watch your position size and take it easy on risk until you get the hang of it. Do not be lured by sexy double-digit overnight gains that these crappy companies give or take. Remember the risk-reward diagonal relationship. The more risk you take, the more money you should make. So if you're losing a lot of money, that means you need to lower your risk. Choosing a discount broker is a very interesting topic because many traders, they will have different personalities, and they have different preferences on a discount broker. For example, some prefer a lower commission, and some prefer paying a higher commission but having a better platform. but for me, I care more about a lower commission and an okay platform. And that's why I choose Lightspeed Trading. Their platform is not as sophisticated as, let's say, TD Ameritrade, but for me, execution speed and very low cost commissions are extremely crucial because I do a lot of volume. So sometimes my trades cost as low as 15 cents, and sometimes I even get paid for making certain trades if I use a particular routing method. And but I mean, most of these, I would say all of these discount brokers that are listed on the PowerPoint slide, they all share pretty similar features like options trading, complex order entries, level 2 codes, time on sales, and advanced charting and risk controls and so forth. So I'm not going to go through each of those platforms, but I am going to take a look at a few of them. Let's go ahead and look at Scottrade Elite. So I have Scottrade Elite pulled up here. They recently changed the platform. It used to be, in my opinion at least, it used to be a much better platform about a couple of years ago, but they've changed the colors, they've added more tools. But anyway, some of the nifty tools that I like on Scottrade Elite, and I haven't used this for a while, but I like the velocity forces. Let me try to remember where it's at. Well, you know what? I see trade ideas. Let me begin with that. They have this cool thing called trade ideas. And if you're a day trader, you just have to pay $15 a month and another 15 one-time activation fee. And what it does is, as you're trading each day, I mean, not each day, but each second, it'll periodically give you different trade ideas. Like you'll say, okay, this stock just hit a 15-minute low, or so and so just hit a 30-minute high or a 6-month high. So it constantly, on the right side of or left side of your platform, it'll stream these different stocks non-stop. So if you're a high frequency trader and you're just sitting there, you don't know what to trade, and you need some type of volatility because let's say the market's pretty dead, trade ideas is perfect because it'll give you exactly different stocks that you can benefit from if you choose. The down part is that I don't think it shows you the volume right there next to it. So you don't want to jump on a stock that has a very low volume. You don't want to touch a thinly traded stock. So hopefully when you look at the stock symbol, you'll kind of check on another screen just to see, gauge the company, how much is trading, their average volume, and so forth. Another thing, let me see, the velocity and forces is another really good oscillator, not oscillator, but a good tool that I like here. Velocity and forces, this one right here. So right now it's dead, but when the market's open, it pretty much shows the momentum. It shows how much, it pretty much takes the time on sales data and it shows it in a speedometer type environment. So you will see half of this green or most of this green and most of this red. So you will see if there's a lot of buying pressure or there's a lot of selling pressure, but at the same time you'll have a velocity gauge here that it will go up all the way to 1,000%. When I remember when Alibaba came out IPO, I mean, this ticker it wouldn't come down from 900%. There's so much trading activity that this was at 900, 800% at least at all times, and usually it just hovers from, let's say, 200 to 400. So you really want to be on those type of trades where there's a lot of trading activity, there's a healthy volume, and you don't have to wait to get a fill. and the commissions are fairly cheap versus other brokers. You have regular stocks $7 as long as you use the internet or your phone, and the broker assisted trades is $32. Who uses broker assisted trades nowadays? When you think about it, it's like, who's still stuck on the 1950s and calls their broker and say, "Oh, place a trade," unless you really don't have internet and you have no choice. But yeah, I don't know. But anyway, you got stocks $7, and options you got $7. Then you got another $1.25 per contract, and then they have a lot of mutual funds that have no fees. They have no load, no transaction fee mutual funds. So those are kind of cool. I don't know if TD Ameritrade has the same one, but Scottrade is fairly reasonable. And their execution speed is really good. I have no problem with their customer service. So I really liked Scottrade. Scottrade Elite, which is the platform that's available for people who have more than $25,000. I don't know if they've changed it now where you have to pay a monthly fee and you can have access to Scottrade Elite. But it used to be where you had to have 25,000 to have it. I really liked Scottrade Elite, even their average platform, Scottrader, where you don't have to have $25,000. It's fairly good too. I'm really happy with Scottrade. I've always had a good experience with them, so I highly recommend it. It's just, again, I use Lightspeed because they give me really cheap commissions, and I'm okay with their platform, even though their platform is a little, kind of looks like MS-DOS version. um, kind of looks like outdated, but it does the job. I don't complain. It has little shortcomings, like I cannot switch from trading stocks to options really fast. That's the only downside that I have, and I don't even trade options that much. I stick to equities, but that's the only downfall with Lightspeed. And unfortunately, I can't show Lightspeed right now because they only allow you to access Lightspeed during market hours. So if it's not market hours, you cannot even access it. Versus other brokers like TD Ameritrade, Scottrade, you can. Okay, now let's go ahead and take a look at TD Ameritrade for a second. It is by far one of the most sophisticated platforms and statistical tools. I think they're the only broker where you can actually go back in history and pick a trading day and restart that specific trading day and redo it all over using a simulator. But the only problem is that you can't get your money back. That's if you took a loss before historically. You can go back and redo your trades. You just can't recover your money because you'll be trading virtually with virtual paper money. But how cool is that, right? I mean, that's the best tool for backtesting strategies and see if you would have done things differently and would they have worked and so forth. TD Ameritrade's original platform, was not that exciting. However, after they bought Thinkorswim in 2009, I believe, for like a little over $500 million, their company took off. TD Ameritrade is great, but I wouldn't say it's user friendly. It's not that user friendly. If you want simplicity and you're just starting out, you want simplicity and user friendliness, then try Trade Monster. They'll give you 60-day free commission trading, just like TD Ameritrade, but their commissions will be like $5 for equities versus $10 at TD Ameritrade. But they don't come close to being as sophisticated as TD Ameritrade. What I like about TD is you can divide your screens into as many like smaller screens, so you can like look at a bunch of different charts at once, and then you can like duplicate this in a different screen, and then look at another 20 charts on a different screen, and if you have 4 charts, I mean, if you have 4 screens, you can look at 80 charts at once. And if you're like a momentum junkie like I am, you can have multiple screens and watching any signs of volatility on bunch of different stocks simultaneously. It's like having eyes everywhere. But remember, you only have 2 eyes. So when you have too many screens, it sometimes works against you and you might lose focus fairly quick. I still have, I still trade with 2 screens and I have another laptop on the side. But the most I had was like 4 screens and I didn't like it. So I went back to like 3. So think or swim. When I say think or swim, I'm talking about TD Ameritrade. Okay, so think or swim is known for their option statistical analysis. And when I used to trade my multi-legged option strategies, this was the place to be. However, I will tell you that the only person who is making money in complex options trading is the broker. Okay, I've seen dozens of people on the internet who state they've made fortunes, trading multi-legged, option strategies like iron condors and butterflies, and they're all full of shit. I can prove you that it's impossible to be consistently profitable using these complex strategies. And these are usually the older crowd, folks in their, late 50s, 60s. They'll never admit the fact that you can make more money on a consistent basis by just trading equities. So when it comes to options trading, the most conservative and I would say consistently profitable strategy, if you had to choose from options trading, would be covered call, or just even simply a naked options call when you get in and get out real quick with a single leg in a momentum scenario and staying 100% cash right after. When you have too many legs open at any options trade and like the implied volatility changes, you end up adjusting your legs and then that eats into your profits. Adjusting your legs, that sounded funny. But anyway, let me stop right there because for those people who are not familiar with options, I'm like probably talking gibberish right now. So lost my train of thought. Oh yeah, so with Thinkorswim, you got it all. You got stocks, you got options, you got forex, you got futures. However, for futures and forex, you have to fill out a special application and get their approval. I'm not too big on either one of them. I stick to equities, and I've traded options for about 5 years, but equities is where I hang my hat. Anyway, Thinkorswim, they have a really good support system. They got chat rooms, live classes, you name it, they have it. And if you don't mind the $10 commission, they're definitely worth it. And I strongly recommend you to have TD Ameritrade as one of your brokers. And I will advise you to always have 2 discount brokers just in case one platform is down for one reason. You always have a backup account that is funded. Guess what, guys? I am happy to announce that you have officially finished part 1 of my seminar. So go ahead and give yourself a round of applause. This was very basic knowledge that any beginner trader or investor should know. The next several parts are definitely going to be extremely informative and more in depth and much harder. Especially part 2. Part 3 should be easier. And they're not this whole thing is definitely not going to cost you $1,000. I think the information I'll be putting into my course is very valuable. That even some of my finance friends, they've told me, hey, I need to charge at least $1,000 for this course, but I'm gonna do exactly the opposite. I'm gonna price it extremely cheap and see what happens. This might even go viral. Who knows? I hope it does. But I want to raise the bar so high for these other so-called posers who try to sell their educational content for like so much money and drone on about absolute bullshit, which is a load of crap. So no one should pay that much money for any advice in the stock market. Most of the real education is going to come from live experience of you actually trading and experiencing losses. Not someone showing you graphs and charts and droning about triple bottoms and head and shoulders and stuff. We get it. It's common sense. When you drop a ball, it bounces. It has support and resistance areas. You're not reinventing the wheel here. Stock graphs work the same way. So, anyway, I promise you that after you learn finance portion of this course, you will feel so much more confident, and you will understand how much disadvantaged most people are who are just starting out, and that there's so much to know and learn. Even I'm learning. It's a never-ending learning process. I've read more than a dozen books on trading, investing, recessions, economies, hyperinflation, and I still feel like I don't know anything. I really don't know much as I should. There's always new things to learn, and a book that was written by Benjamin Graham long time ago, it's pretty much useless now with the advent of internet, and things are very different now. Um, so you will also soon learn that also technical analysis was kind of like a bullshit way to fool the retail investor to kind of add liquidity into the market by allowing uh, newbies to kind of cheer in their seats when they saw flashing green and red bars. It was just a way to make it more presentable to the average investor, because with that and with short selling, that created so much more liquidity, and people spend so much more money on buying and selling stocks, even when they don't win. you know Brokers win, but people most of the times they don't win. um, and you will understand how easily technical analysis patterns can fail when a large institution hides its large block purchases and scales in and out incrementally, completely uh, erasing out any technical analysis pattern like a Etch-a-Sketch. You know, so stock market is like the filthiest casino that makes Las Vegas look like a walk in a park. And unless you know exactly what's going on, then you're one of those idiots who just watches the Fox News and believes everything that's being said. You're being fooled. So anyway, the reason I wanted to make this educational course is because I get annoyed at some of these penny stock promoters who show off their overseas travels, smoke cigars, talk about buying Lambos just to get people hyped up to buy their piece of the American dream with like a sense of false hope. They're just BSing people and telling people, oh, they make triple digit gains and they can do the same thing and blah blah blah. Hey, look, I'm trading from Fiji Islands now. I'm trading from Bahamas now. Nobody trades from Fiji Islands. Okay, you're there for a vacation. Close your laptop and go have a Mai Tai. If you're gonna trade from Fiji Islands, why do you feel the need to have a professional camera crew follow you around? It's just so stupid. I can't believe people buy into that crap. So I recently spent almost 2 months driving across North America. I didn't trade once. Okay, I didn't even want to look at the stock market because I was in my vacation mode. People would ask me questions about stocks on Facebook and I would just ignore them, because I just wanted to focus on my exploration and traveling, which I take very seriously. Look, guys, if someone is a really good educator or a promoter, then they're not a really good trader. Statistically, I think the odds are realistically low if you think about it. Um, Honestly, I don't think I'm a good educator at all, nor can I talk very efficiently, since English is my third language. So I have to instantly translate sentences in my mind from Armenian and then speak it the right way in English. It's been 20 years that I've been in this country, but it's still challenging at times. I stutter sometimes, and because it's not my native language. So sometimes when you translate, things don't come out the right way. But anyway, honestly, I don't even want to teach, but I really don't. But I think that over the years, I learned a lot that I should share the public with. My main goal is to save you as much money as possible from trading losses and give you as much knowledge as I possibly can, along with great tips and hints that will stop you from making the same mistakes that I did. Alright, guys, thank you for listening, and prepare for part 2, which we will discuss the Edgar's method and dive in straight into fundamental valuations. So make sure you're in front of a computer this time with a calculator instead of lounging on a couch like you did on this part. All right, so now go and choose 2 discount brokers and pick one that'll give you some of the best categories listed on this bullet points here, such as fast execution speed, reasonable commission price, good platform. Alright guys, see you on part 2.